Hi investors, welcome to another interesting video and a deep dive into a company in the defense space. The name is Krishna Defence and Allied Industries. Let's quickly have a snapshot of the key metrics. So revenue clocked in FY25 is 196 crores. EBITDA percentage is healthy at 15.6 and the PAT has crossed 10%. It is 11.3 last year. The company has a market cap over 1100 crores and it is a SME progressing into a main board company. So before we get into the details, let us understand what is the opportunity that has come to Krishna Defence. So with the defense acquisition procedures that got laid out in 2020 by the Indian government, the Defense Advisory Council, where there is a strong focus on modernization through indigenization, that is manufacturing locally in India, and import substitution. This is a very big opportunity, and within that Krishna Defence has already been producing steels, welding alloys of certain quality, which have led to substitution of what was getting imported from Russia over the many decades prior to these procedures. So it is in a sweet spot where it has got various accreditations and it is already inside the Navy's roster to supply these kind of materials to them. So it is rapidly advancing defense company providing critical components to Navy and now Army. Also, there are some requirements from Air Force. It has shown the capability to be a vertically integrated defense solution provider, and it has comprehensive in-house research capabilities. So they are obviously going to work closely with DRDO and its arms to co-design and co-develop various products for the defense forces. Not only is this an opportunity for Navy shipbuilding, but also commercial shipbuilding, as we will study ahead. So they started off as a dairy equipment company in Kalol near Baroda, and at Halol they have a big defense products factory now. Let's look at some of the important milestones. Set up in 1997 for manufacturing of dairy equipment, entered the defense sector in 2006 and really got going around 2008 when they had a tie-up with DMRL Hyderabad for transfer of technology partner and started manufacturing these special shipbuilding steel sections used in warships. It got listed as a SME on 2022 on NSE, and they've got the in principle approval on 8 December 25 as we speak for migrating to the main board in a 45 days window. The good part is a big capacity expansion has already happened and that should help them to grow. So this slide of the first slide of the three products gives you a fair idea where 80% of the current revenue of the company is coming from. So as we discussed, this is special type of steel which is not manufactured by the larger players like Tata Steel Cell, because they manufacture millions and million tons of steel, and over here we are looking at a few thousand every year. This is a good stiffener where the quality of the hull of the ship gets determined by the quality of steel, the strength and the weight. So the ratio of strength to weight 1:3 means the weight is less, the strength is very high, which means with a lower weight you have a more strength to travel as well as take the knocks at lower temperatures, higher temperatures, salty water, waves, and you are able to carry more provisions, supplies, crew on board because the inherent weight of the ship is less. So they certainly have made good inroads over here. Next is your sections which are important for supplying to any recognized naval shipyard. So DNV and ABS class, this is of Norway and this is of US, that is American Bureau of Shipping. These certifications are required for supplying these bulk bars to the Navy. This opens up opportunities in the non-defense space as well. Then what we discussed is, as you make the steel for the plates that get welded to make a ship, the welding joints are very important. And at these welding joints, again, if you don't have a specific welding wire of an alloy, DMR 249A, and welding electrodes, then again, you have a weak joint. And as they say, any chain is as strong as the weakest joint. So आपके जो hinges है, आपके जो joints है, those have to be stronger than even the main structure of the ship, because that holds the entire ship, its platforms and everything together. So these are the three key important products. Next we come to special alloy ballast bricks. Now this is more of a lower end product which is used in creating platforms on the ship and off the ship. Same with armored steel profile, which is currently used in the manufacture of armored vehicles, as well as the main warrior tank that the Indian Army has, which is called as T-90 or Bhishma. And then you also have the traditional name Bukhari, which is a space heating device used by Army in very, very cold, frigid temperatures. So these are forming lesser part of revenue, but over here we see many orders coming because these are started recently, but these are likely to be lesser margin order compared to the earlier products that we discussed. In the clients, you have who's who of the Indian Navy, Army, the shipyards, and of course, as we saw in the products, the main products are being supplied currently in the shipbuilding space. So you will find all the shipbuilding shipyards over here. Let's spend a minute on the dairy product, which was the legacy business and which is still going strong. So surprisingly, this business had 22% of revenue share in FY22. Then the defense vertical grew very fast, where in FY25 they did 4% on these products. But surprisingly, in H1 FY26, it is 8% again. So this is the regular milk collection containers of steel. Then these are how to make the milk cold within a few hours of milking the cow, that is needed as a part of the process. Then there's a milking machine. But most importantly, this is a robotic milk collection, which is a patented product of Krishna Dairy for the next 10 years. And I believe the main growth is coming from here. Why? Because over here, this becomes a effortless value chain for the entire milk. So whenever a dairy farmer brings his gallons of milk, they can be put over here. Immediately, you get a professional understanding of the fat, SNF percentage, and other adulteration related readings. And the person or the middleman who is buying can then decide the rate of the milk. So everything is happening through a third party through a machine. So there is very less scope for haggling, cheating, and the farmers will not get shortchanged. Let's look at the defense industry overview. So over here, I would like to tell you that we have done a deep dive on the shipbuilding sector on the 7th of December, where we have covered all of this in detail. And if you want to access that, the link is available in the description of this video. So क्या हुआ है? First of all, in September 25, as recent as 3 months back, the Indian government has made a new policy on the shipbuilding sector, which is not only for Navy but commercial shipbuilding also. What helps is they are going to give an infrastructure status to a ship, just like an airport, just like a big railway station, which means it is not a standalone asset, but it is a national asset as an infrastructure, which means your access to project financing gets better. Now, by nature, shipbuilding is a very long-term activity. The smallest vessel like a frigate or a corvette takes 4 years, and aircraft carrier, which we have only two, INS Vikrant, takes more than 10 years. So what is the benefit of this policy? For such a long gestation period, you get a long duration loan at a lower interest rate. If you don't have infrastructure status, you is exactly the opposite. You will get a shorter tenure loan at a higher level of interest. Lower provisioning, very important. With this status, now the provisioning can be up to 1% of the loan amount, unlike again other assets for which you loan. So again, a lot of motivation for lenders to open up their lending books. And flexibility in DCCO extension. मतलब क्या है कि एक शिप अगर 7 साल में बनने वाली है, it goes on to 9 years. So typically a lender, what he would do is a project finance for 7 years. He would like to pull the cord at the end of 7 years. But in this case, because of the policy, he will continue to have the loan open for another 2 years, and the shipbuilding company can focus on its operations without trying to run out of cash. What it will do is boost new build projects and a preference for indigenized inputs, which is good for Krishna Defence, shorter procurement cycles. India has the ambition to be among the top 5 shipbuilding nation. I think practically we have done nothing in the last few decades. And we have a long coastline, defense budget is increasing every year, and exports are also growing. So everything good about this sector. What we see over here is the opportunities that are coming. So India wants to have its fleet size to 175 by 2035 with indigenous production, local production, not imported. So 68 new vessels are presently on order with a contract value of 2.3 lakh crores, which is almost 3x of the current order size of the main shipyards. These three are very familiar names now. Mazgaon Dock, Cochin and Garden Reach. The rally that we saw in the last 3 to 4 years in these companies is not only because they got new orders and executed them, but a lot of money has already got invested for the next decade of growth. So this is a theme which is essentially long term in nature, and we are seeing policy, financing, capex, expansion and order booking, everything coming together. This is a quick snapshot of the Maritime India vision. This is what happened a couple of months back. And over here again, there are some good points which are going to help. That is green technology for making vessels, advanced materials, modern composites, and Krishna Defence, as we will see in the actions, is positioning itself at the center of all this. So certainly a long-term vision of the management is very clear. Now the next two slides will tell us how they are collaborating for transforming from a heavy metal manufacturer, जैसे हमने जो products देखे हो mainly steel, welding, alloys, electrodes में थे, into an integrated defense technology company which includes electronics, composites and designs. So there are three companies where it has done a tie-up. Waveoptix Defense, it's in early stages of revenue. It has a revenue of 18 crores and a PAT of 5 crores. So about 30% of PAT. So this is very good because it is helping in electronics, radar, communications. So when we analyze the defense sector over the last few years, we have realized that the highest margin or the profit pool was with companies like Data Patterns, Astra Microwave, Avantel, for the simple reason that they were dealing in these kind of systems which are related to radio frequency communication. And with Waveoptix, Krishna Defence is taking a step in that direction, already taken, and it has increased its stake from 25 to 40%. So over there we have seen margins as high as 40%. VABO Composite, which is mainly for the final trial and testing phase of doors and hatches. Over here again the target is new ships being constructed and later on a replacement market also becomes open for them. The management has been transparent that this revenue opportunity is likely to come in 12 to 18 months because currently production, trials and inspection is going on. They are still some time away. Conceptia Software, again 20% stake, a 40 crore top line company with 2-3 crores of PAT, which is fairly good. And this can be their engineering and design arm where they can design and build package. So what we studied in the first flight to become an integrated design, develop, produce, all this is going to help them, and they should also have a good effect on their margins. This slide is very important for understanding in the next 2 years what is likely to happen, what revenues are going to kick in based on what are the advancements in the current products product profile that they do. So in the customized and specialized weld consumables, which is super alloys, welding wires, they are getting a lot of interest from the aerospace. Already products are being produced for a trial and the revenue is likely to cook in the next 1 to 2 years. Even for the hull structure, the specialized steel as well as alloy ballast bricks, those complexities that go into the armored vehicle, again there has been some traction in the aerospace part, and revenue generation for army which has already started is likely to ramp up in the coming years. As we discussed, the brownfield expansion project at Halol got completed in April 2025. So this should lead to operational efficiencies as we go ahead, and we are already seeing a expanding margin profile due to that in the H1 of this year. These certifications, international certifications, very important, and the good news over here is not only is it good for the naval shipbuilding, but over the last year they have already done supplies to Cochin shipyard for a commercial ship that was built and exported by them. So again, for the export market of a shipbuilding company, their grade of products has already made the cut, and they've also supplied to Coast Guard for certain commercial ships, naval platforms, which is typically outside the Navy's domain. So they are already making forays into the commercial shipbuilding. Another important development emphasized by the management is with respect to Jalkapi. So it is the extra large unmanned underwater vehicle. So a new type of submarine which is very large, which can stay underwater for months. It does not need to come up for catching its breath or the oxygen part. This is already under construction in their factory since July 2025 as per the naval design, and the revenues might start kicking in as early as FY27. So financial highlights, the top line has become 3x. These two are the difference between the defense and the dairy, the distribution. The EBITDA has gone up from 13 to 15.6% till FY25, and net profit is in double digits, net profit margin. Again, very good growth from H1 of last year to this year, more than 30%. And the EBITDA margin of H1 this year is close to 18%, which is very good for this kind of the current level of products that they have. And the net profit is gone to 13%. Now, this is very important. There is some good news here and some concerning news. The net to debt to equity ratio for a company which has completed doubling its capacity, having this line is very surprising. Ideally, ऐसे दिखता है, where you will start with a low borrowings, and at the end of the capex cycle, the borrowings would be high. So the management has said that for the last 15 years being in this industry, a lot of base capex, buildings, machinery, everything has already been there. And now even in the next 2-3 years in the growth phase, where they are wanting to go from 200 to 500 crores, they might require up to only 10 crore capex every year. So that's a great thing because the internal accruals can get there. But the concerning part is where the CFO to EBITDA was very high and positive before the hyper growth phase has faded and into negative territory, which means they are reporting a good EBITDA in crores, but their cash flow from operations is negative. The main reason is that they have managed to reduce their payable days and the receivable days, which is debtors, but their working capital days of inventory is still very high, which is 270, which is in 9 months. Okay. Now, at this point of time, there are many suitable reasons been given, like when the capacity doubles, you have to have a much higher inventory. When you are making so many product trials, again, you are buying a lot of stuff, it is subject to inspection and then revenue booking. Then there are also certain orders which are long term in nature now because they have made inroads into Navy's approval process. So when you get longer term orders, you make a lot of inventory and the billing can happen again. So there's a lot of dependency now on inspection and final billing and certain other guarantee liabilities, retention money. But at the same time, we are very clear that if they continue to grow at this pace, and this is the overall working capital which is more than 300 days, which is close to a year, the time is not far when they will have to raise money purely to manage their working capital cycles. The internal accrual se hoga nahi. Management interaction has been good, where they have been promising 30 to 40% CAGR of revenue and getting to 500 and then 1000 crores as they continue to grow. We've already seen that in terms of trying to become a more integrated supplier from design to that has been discussed in detail in the con calls, which you can go through. EBITDA margin already improving, and as they get the operating leverage, as the revenues and the P&L parts of the subsidiary companies or JVs which have a higher margin profile keep on integrating, this is likely to go up. But more importantly, we have to, as investors, we have to keep an eye out what happens over here, because in the next growth phase you will get orders, you will supply, but the revenue booking itself will be lumpy and the collection also can be lumpy. So this is going to be a watch out factor. One thing that was slightly surprising was the order book that they had at the end of March 25 versus what they had at September 25. The cumulative order book has actually gone down. So actually in a hyper growth phase it should go up, and we did not find convincing answers from the management why it has gone up. So a couple of reasons were given, where the expansion factory is more automated, so their turnaround time for production has gone up, which means the orders are getting serviced faster. But at the same time, if we look at the context, that today for the last 6 months we may not have got clear answers from the management, but if you look at the next 6 months to 1 year, as the orders keep on flowing to the shipbuilders, Krishna Defence is also going to benefit from those orders. There is no doubt about it. It is how they are going to manage their growth that remains to be seen. Valuations, we have included around 30 to 40% growth in top line and some more in profits due to operational efficiencies, closer to what the management had said. And at the we had this company at a trailing P of more than 60 1 year back. It has corrected sharply, and at the current price, if we factor in where they would be at the end of FY26, it would be 29x trailing P, and at the end of FY27, which is only 15 months from now, around 23 P. So one thing is for sure, as they keep on growing at this pace, they will continue to get cheaper. By no means this should be considered as a valuation metric of PE to bet upon, for the simple reason is valuations are very relative. Just one or two set of numbers cannot give you a valuation which is relatively cheap or a conclusion for investing. Key risks. I think the presentation has more or less made us clear about the risk, because as an investor, generally these matter more than all the growth opportunities. We already know that these are the sectors where hyper growth has come and it will continue to come. But where is it that we want to invest is companies which are able to manage their growth well. So client concentration risk, we saw the customer profile. Those are all like similar people. The names are different, but the profile is the same. And if at all there is a government delay in the shipbuilding project or budget allocation in a particular year, there is always a possibility that the growth can get stalled for some time. And in today's world where investors want to jump to conclusions based on quarterly results, this is certainly risky for a long-term theme. Working capital crunch we have already discussed, and raw material volatility, this is an important part. So it is all based on steel, and steel can have very rapid movements in price on either side. So in case they have fixed price supply contracts which are a year or more, and they are not able to pass on when there is a big increase in the steel price, that is going to affect their margin. That's a given. Lumpy revenue, we have already discussed this, and policy slowdown and reversal. So sometimes what happens is, for a couple of years, due to lack of budget or other priorities, particular sectors can have reduced budget allocation. That will have a direct bearing on Krishna Defence as well, because it is a direct proxy to shipbuilding as of now. Disclaimer, as you know, we are a SEBI registered analyst, hence all the information here should be treated for educational purposes only. Anything said or presented here should not be construed as investment advice, and please do your own due diligence before investing. So thank you.